The following podcast was recorded on Thursday, March 17th, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everybody to Talking Data. I'm Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Hey, thank you.
Today, Sam will discuss the Fed's announcement and its ties to inflation. Sam, the Fed announced the 25 basis point hike yesterday that was widely anticipated. Can you talk about its path forward? What will the main focus be on inflation and what should we expect?
Yeah, so I think it's interesting, right? The 25 basis point hike, everybody expected it, whatever. That wasn't really a big deal. What was interesting was the way that they described the future, how they're thinking about inflation, how they're thinking about unemployment, how they're thinking about the balance sheet moving forward, and exactly how all of that kind of melds together. I think there were kind of two major takeaways. The first one was that at a coming meeting, which is code for probably one of the next two, they were going to begin shrinking the balance sheet, actually reducing its holdings, which I think is interesting. I don't think people were quite as prepared for that little tidbit of information as they probably should have been. It was pretty well known that they were going to cease buying additional assets in March. That was kind of just on the radar for the last 3 or 4 months, but it wasn't expected that they were going to do QT quite that quickly, right? You were going to go into a quantitative tightening right around the corner. And the reasoning behind that, at least in the way that they began to describe their outlook for the U.S. economy, was that the unemployment and general picture for the U.S. economy was very bright, right? That was what Chair Powell kept going back to basically the entirety of his press conference. The focus was all about how to get inflation under control. And the Fed was very adamant, and Powell made it very clear that they were there to fight inflation, and unemployment and the growth picture weren't anywhere near as important as it had been. And I think this first chart that we have here, that really this is going into the Fed meeting, what the expectations were for rate hikes and the probabilities assigned to them. This was pretty dead on in a lot of ways. This is pretty much the path that the Fed laid out. Maybe one more hike would be added to this chart after yesterday. But in general, it was pretty much we're going from a quarter point now to about 2.5% sometime in the middle of next year. It's going to be a pretty consistent pace of hikes, 25 basis points, pretty much every meeting unless there's a very large road bump somewhere that hits unemployment hard. But it's going to have to be a fairly significant hit to the unemployment rate to knock them off this path.
And let's talk next about inflation expectations, specifically as you look out for the next 10 years.
Yeah, this is one of, I think, probably the most important piece of the puzzle that's being a little overlooked, is that inflation expectations are beginning to become a little unanchored. That's what's really concerning the Fed. It was pretty well known that in the next couple of years, you're going to have higher inflation. Even in the next 5 years, you're going to have elevated inflation relative to history. At least that was the expectation. But the headline CPI over the next 10 years, that's where you begin to have a 2.5%, 3% probability above 50%. That's beginning to unanchor the U.S. consumers' minds when it comes to how to think about inflation, and that's over a very long period of time. I mean, this is something that you haven't seen at least since the data started, right? At 2.5% here. The highest probability was in 2014. We all remember that was a pretty interesting time in the Fed's history to begin with. Now it's at 92%. So you're wildly above the anything we've seen in this data set. For 2.5% and 3% is above 50% for the first time ever. I think that's really disconcerting for the Fed here. If you're going to have inflation expectations running hot for 2 years, that might be fine. 5 years, a little disconcerting. 10 years, that needs to be dealt with. And I think that's really what the Fed's narrative of 6 to 7 hikes this year is really all about. It's re-anchoring those inflation expectations over the next 5 and 10 years, not necessarily the ability for them to get inflation under control in the near term.
I think we have one more chart here if we want to switch. If you want to talk about the CPI.
Yeah, and this is call it the Fed's real problem, right? That they are going to have elevated inflation for the next year and a half, pretty much regardless of what they do, right? They're going to either have to break demand, which would be basically putting the U.S. economy into at least a mild technical recession to break demand down so that supply can play some catch up, or they're going to have to deal with it, or they're going to have to deal with a little bit of inflation. And that's the reason I don't think this is all about fighting near-term inflation. It's a lot about making sure that they're not losing control of future inflation expectations in any meaningful way. And to be honest, it was beginning to look as though they were missing the narrative quite a bit here.
And Sam, recently, besides the war with Ukraine and Russia, we've had some shutdowns with China, a new COVID case potentially emerging in Europe again. Can you touch on the status of the supply chain?
Yeah, it's a train wreck. So we'll start in China. The shutdowns and the zero COVID policies are going to continue to be a significant issue coming out of China. It's simply they're not reopening at the pace that the U.S. did or that they did initially. It's worth remembering that they were the first country that really reopened and got back to work pretty quickly after COVID, the initial wave of COVID. This time around, it's basically rolling shutdowns for the Chinese economy, and that is going to continue to play a critical role in lengthening those supply chains, right, or breaking them down. Whether it's shipping and containers, et cetera, it's going to continue to be a problem. I think the war in Ukraine and some of the tidbits there, neon and the semiconductor problem, that's going to filter through and potentially really extend the lifeline of semiconductors and how long it takes for them to come back. It's also worth noting one of the major shipping companies recently announced they had 50,000 empty containers in Russia that they can't get access to, right? And what those would be pretty useful in terms of putting things on a boat and shipping it back over to the US. They don't have access to them at the moment. So there's a lot of things that rolling shutdowns due to COVID are affecting in China. But there's also a lot of pieces of the puzzle that are really becoming problematic for the supply chain due to the war that I don't think were thought of before sanctions were put in place, or two, are really being taken into account at the moment.
So should our new narrative be stagflation?
Yeah, that is the new narrative. In the final chart here, I love this, is the volatility between the transitory narrative of inflation will be transitory and stagflation from Google Trends. This is just a great chart that right now, transitory has basically fallen off a cliff in terms of the narrative, while stagflation is really beginning to come to the fore and probably will continue to be the narrative until you have a shift to something like recession or something along, or Fed begins to become a little more sensitive to employment and begins to back off the tightening narrative. Until then, it's going to be a stagflation narrative.
And I always like to end with asking you, what should we be watching next?
Well, now that we have the Fed out of the way, I think the main thing to begin to watch is whether or not companies begin to come out with warnings for Q1 earnings in any way. Typically, that would be in the next week or so that you would begin to see warnings, whether it's due to supply chain, whether it's due to the war in Ukraine. Begin to watch for the narrative around earnings season as we approach.
Thank you, Sam, for your thoughts today, and thank you everyone for joining us. We are client-driven. If you have any questions or feedback on future topics, please let us know. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.